The housing market is showing cracks that nobody's talking about, and D.R. Horton insiders know it. In the last 3 months alone, D.R. Horton executives have dumped over $5.4 million in stock, and the timing couldn't be more suspicious. Hey everyone, welcome back. Today, we want to share something that's been keeping us up at night. We've spent countless hours analyzing data, speaking with industry insiders, and connecting dots that paint a troubling picture of what's coming in the housing market. What we've discovered isn't just concerning, it's downright alarming. Let's start with what initially caught our attention. D.R. Horton's executive chairman, David Auld, recently sold $3.9 million worth of shares at $156. Around the same time, another insider, Barbara Allen, liquidated $922,000 worth of stock. But here's what really raised red flags for us. There's been absolutely zero insider buying. None. When insiders are unanimously heading for the exits, it's time to pay attention. And here's what's really fascinating. This insider selling pattern isn't happening in isolation. We've studied the last 3 major housing downturns, and there's a pattern that keeps us up at night. In 2006, executives at the top 5 home builders sold a combined $300 million in stock before the crash. The scary part? Today's insider selling volume is actually higher when adjusted for inflation. History doesn't repeat, but it often rhymes. Let's break down where D.R. Horton is seeing the most pressure, because the regional data tells an even more concerning story. In Phoenix, one of their key markets, cancellation rates have hit 32%. That's nearly 1/3 of all contracts falling through. In Austin, they've quietly increased incentives to the highest level since 2008. And in Florida, they're reducing their land holdings by 25%. When you see a company pulling back in their strongest historical markets, it's time to pay attention. The market data that mainstream media seems to be overlooking paints an even darker picture. Builder inventory levels have surged 21% year over year, while the months of supply has jumped from 4.1 to 6.2 months. But here's what's really concerning. These numbers don't even include their shadow inventory. Looking at satellite imagery and building permit data, we've identified over 15,000 additional units that aren't being reported in their official numbers. We're seeing partially completed homes, permitted but unstarted projects, and what builders call spec inventory. Homes built without buyers that aren't yet listed. When you factor in this shadow inventory, the real months of supply jumps to nearly 8.5 months, a level we haven't seen since the last housing crisis. The affordability crisis we're facing is unprecedented. With mortgage rates hovering around 7% and median home prices up 45% since 2020, monthly payments on a median-priced home have skyrocketed by 52% year over year. This isn't just a statistic, it's pricing an entire generation out of home ownership. Now here's where this story gets really interesting. D.R. Horton's public statements and actual actions tell 2 very different tales. While they're publicly projecting confidence, talking about strong demand and healthy market conditions, their actions tell a different story. They've quietly increased incentives by 60% compared to last year. They're offering rate buydowns on more than 70% of new contracts, and they've slowed land acquisition by 35% in key markets. Actions speak louder than words, and their actions are screaming. Now let's talk about something that's flying completely under the radar. The creative financing happening behind the scenes. D.R. Horton has increased their use of joint ventures by 85% year over year. They're offering more seller financing than ever before. If this sounds familiar, it should. These are the exact same techniques we saw in the lead up to 2008. When builders start getting creative with financing, it usually means traditional buyers are disappearing. Let me show you exactly what I mean. In their latest earnings call, they briefly mentioned alternative financing solutions. Digging deeper into their financial statements, we found they've created 6 new financing subsidiaries in the last 8 months alone. They're offering buy now, pay later options on down payments, something we haven't seen since 2007. Their mortgage subsidiary has increased its subvention rates, that's fancy talk for builder-paid closing costs, by 140% compared to last year. But D.R. Horton isn't alone, and that's what makes this situation even more concerning. Looking at their competitors paints an even darker picture. Lennar has increased their incentives by 45%, Pulte has slowed land acquisition by 30%, and KB Home's cancellation rate has hit a 5-year high. When every major player in an industry starts showing the same stress signals, It's not a coincidence, it's a trend. But this story gets even more worrisome when we look at what's happening behind closed doors. Recent internal communications leaked from D.R. Horton reveal a company-wide hiring freeze across multiple divisions. The documents also show they've quietly slashed their marketing spend by 40% in key markets. These weren't public announcements or press releases. These were internal directives meant only for senior management. Think about that for a second. Why would a company claiming strong market conditions be secretly cutting costs across the board? These are classic signs of a company preparing for rough waters ahead. And here's where the puzzle pieces really start coming together. These internal cost-cutting measures began just 2 weeks before those major insider stock sales we discussed earlier. Remember those millions in stock that executives were dumping? Now we know what might have been driving those decisions. The pattern is clear. The internal actions tell a very different story than the public statements. Here is the most mind-boggling part of all this. Wall Street is completely missing these warnings. Despite all these red flags, 65% of analysts still rate D.R. Horton as a buy. This feels like deja vu from 2007, when 70% of analysts had buy ratings on homebuilders just months before the crash. The disconnect between Wall Street's optimism and insider behavior is stunning. Remember, insiders make money by knowing their company better than anyone else, and right now, they're selling. And here's something else Wall Street is missing: the smart money movements behind the scenes. Major hedge funds have reduced their positions by 15%. Short interest has increased 32% in 3 months, and the options market is showing increased put buying. These aren't random movements. This is sophisticated money positioning for a downturn. What makes today's situation potentially more dangerous than 2008 is the nature of the crisis. Back then, we were dealing with a subprime lending problem. Today, we're facing something more fundamental: an affordability crisis coupled with a supply chain nightmare. Home prices are now 58% higher than 2008 peaks when adjusted for inflation, while wage growth has only increased 12% in real terms. Building material costs have surged 35% since 2020. Labor costs are up 45%, and development timelines are 40% longer. Let me share some data that really puts this in perspective. In 2008, the average home buyer needed about 32% of their monthly income for a mortgage payment. Today, it's a staggering 46%. That's with stricter lending standards and higher down payment requirements. D.R. Horton's own data shows their average buyer's debt-to-income ratio has increased from 38% to 43% in just the last 18 months. The technical signals are flashing red across the board. Housing starts have plummeted 18.5% year over year. Pending home sales have dropped 12% in 6 months. And builder confidence has fallen for 8 straight months. D.R. Horton's financials tell the same story. Gross margins have compressed by 280 basis points. Expenses are rising faster than revenue, and free cash flow has declined 25% year over year. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue. Here's what makes this market fundamentally different from 2008. First, we have an institutional ownership problem. Large investors now own 35% of single-family rental properties, compared to just 8% in 2008. This means when prices start falling, we could see institutional investors dumping properties all at once, accelerating any downturn. Second, we're seeing a massive shift in where people want to live due to remote work. D.R. Horton's internal surveys show 45% of their recent cancellations cited location flexibility as a key factor. They're stuck with land and developments in areas that might not match future demand. So what does all this mean for you? Whether you're a potential home buyer or an investor, these signals demand attention. Let us break down exactly what you need to watch for and how to position yourself. For home buyers, patience might be your best friend right now. Here's what we're seeing on the ground. Builder incentives are not just increasing, they're accelerating. In the last 60 days alone, D.R. Horton has rolled out new incentive packages in 37 markets. We're talking about rate buydowns worth up to $15,000, closing cost coverage up to $10,000, and even free upgrades that used to cost extra. The sweet spot for negotiating is coming. But timing is everything. Watch these 3 key indicators in your local markets. First, monitor the days on market for new construction. When you see this number creep above 120 days, builders typically get aggressive with price cuts. Right now, we're at 98 days and climbing. Second, track the cancellation rates. The higher they go, the more desperate builders become to move inventory. We're already seeing cancellation rates approach 25% nationally. When this hits 30%, expect major price adjustments. Third, watch the spec home inventory. These are homes built without buyers, and they're the builder's biggest liability. D.R. Horton's spec inventory has doubled in the last year, and they're sitting on nearly $2 billion worth of completed homes without buyers. For investors, it's time to think strategically. The signs we're seeing suggest a significant shift is coming. Here's how smart money is positioning. They're reducing exposure to builder stocks ahead of what could be a turbulent period. The options market is telling us something big is brewing. Put option volume on homebuilder ETFs has tripled in the last quarter, but this doesn't mean there won't be opportunities. In fact, some of the biggest fortunes in real estate were made by those who positioned correctly before market shifts. Watch for distressed land deals. We're already seeing builders quietly shopping their land holdings at 15 to 20% discounts to book value. The key is to stay ahead of the curve. Keep your eye on these critical data points: monthly changes in builder incentives, cancellation rates by market, spec inventory levels, insider transaction patterns, and most importantly, the spread between list price and actual sale price. Remember, markets don't crash overnight. They crack slowly, then all at once. The smart money is already moving. The question is, will you be ahead of the curve or behind it? This brings me to one of the most powerful tools successful investors are using in today's market. Smart investors are using tools like foreclosure.com to be first to know when foreclosures hit their target markets by signing up for free alerts on foreclosure.com to catch investment opportunities the moment they arise. We've included the link in the description below. The housing market is at a critical juncture, and the signs are becoming impossible to ignore. Let's recap the key warning signals we've uncovered. D.R. Horton insiders have sold over $5.4 million in stock while offering zero insider buying. Their regional data shows markets like Phoenix and Austin flashing red, with cancellation rates hitting alarming levels. They're using creative financing techniques we haven't seen since 2008, and their competitors are showing the same stress signals across the board. Wall Street might be missing these warnings, but the smart money isn't. The institutional investors who called the 2008 crisis are quietly positioning themselves for what's coming. Remember, in times like these, it's crucial to watch what the insiders do, not what they say. Before we wrap up, let me share one final piece of data that keeps us up at night. In the last housing downturn, the builders who survived were the ones who recognized the warning signs early and took decisive action. D.R. Horton's own actions, from their insider selling to their land strategy shifts, suggest they see something coming. The question is, do you? Here's what you need to do right now. If you're thinking about buying a new home, bookmark this channel. Over the next few months, we'll be releasing detailed market-by-market analysis showing exactly when and where the best opportunities will emerge. If you're an investor, pay close attention to the next few earnings calls. Watch for subtle changes in language around market conditions and buyer incentives. These seemingly minor shifts often precede major market moves. And if you found value in this analysis, hit that subscribe button and notification bell. The situation is developing rapidly, and you'll want to stay ahead of what's coming. Drop a comment below, too, with your thoughts on the housing market. Are you seeing similar patterns in your local area? We read every comment and respond to as many as we can. This isn't just about predicting a downturn. It's about being prepared for whatever comes next, whether that's protecting your investments or positioning yourself to take advantage of opportunities others might miss. Thanks for watching, and watch this one as well.